With markets jumping all over the place, it's pretty natural to ask, is now a totally crazy time to be investing? Well, today we're going to break down why these volatile times might actually be the best times, but only, and this is a big only, if you can master the one thing that trips up almost everybody, your own emotions. Okay, let's get into it.
And you know, this really gets to the heart of it, doesn't it? This quote just perfectly captures the real battle in investing. It's not about finding some secret perfect stock. It's about managing your own head when it feels like everyone else is either panicking or getting way too greedy. Your biggest opponent isn't some Wall Street genius. It's the person looking back at you in the mirror.
All right, so let's tackle those big, scary emotions head on, fear and panic. They are probably the biggest roadblocks to building any kind of long-term wealth. So we really need to understand exactly how they work against us.
Now, this is super important. What you're looking at here is basically a two-phase trap. It's like a 1-2 punch that just wrecks your portfolio. First, the market drops, fear completely takes over, and you hit sell. That's phase one, and boom, you've just turned a temporary dip on paper into a very real permanent loss. But phase two is just as bad. You're now so spooked that you just sit on the sidelines in cash and you completely miss the market rebound when it comes. And it always comes. That cycle is what structurally destroys wealth.
So, if panic selling is a bad idea, you might be thinking, okay, I'll just play it really safe and keep my money in cash. Makes sense, right? Well, maybe not. Let's talk about the silent threat that's eating away at your money even when you think you're not taking any risks at all. Before we even dream about getting rich, we have to talk about something way more basic. Just not getting poorer. The number one job of your savings, your capital, is to protect its own value over time. And the biggest threat to it isn't a dramatic market crash. It's something much, much quieter. And that enemy is inflation. You can think of it like a silent tax that just sneaks into your bank account and shaves a little bit off the top every single year. In fact, most central banks actually want about 2% inflation, so your cash is literally designed to lose a little bit of its buying power year after year. To make this real, just look at the price of something simple, like potatoes. A kilogram that cost you 64 oppen back in 1970 now costs over 2.5 franken. That's a 2.7% price hike every single year. The potatoes are the same, but the value of the money you need to buy them has just plummeted.
And this is the question everybody asks. I mean, you see those little interest payments pop up in your savings account and you think, great, my money's growing, but is it really keeping up?
And here's the tough truth. A lot of the time, the answer is a hard no. The reality is, after you subtract what inflation took away from the tiny bit of interest you earned, you're often left with a negative number. You are actively losing purchasing power by keeping your money safely in the bank.
So if a savings account is kind of a losing game against inflation, where do we find that real long-term growth? Well, to find the answer, we have to look to the capital markets. Let's see how this works.
Okay, now check out these numbers because this is where it gets really interesting. If you'd put 100 Swiss francs into a savings account back in 1969, today you'd have about 300. Okay, not terrible. In bonds, you'd have 850. But in stocks, whoa, you'd have 5,500 francs. That is a staggering 55 times growth. But wait, that's not even the whole story.
Because this chart is the one that really truly matters. This is what's left after that silent thief inflation has taken its cut. That savings account, you basically just broke even. You have pretty much the same buying power you started with 50 years ago. Bonds did okay, giving you 2.5 times your money. But stocks, they grew your real spendable wealth by 16 times. This is the only asset class here that dramatically outpaced inflation and created significant new wealth.
Okay, I can practically hear you thinking it. 16 times growth sounds amazing. But what about the terrifying drops, the scary headlines, the risk? And you're right to ask. So let's try to reframe that fear by actually looking at the data.
I love this table because it makes what feels like complete chaos seem, well, normal. A little 5% dip, expect it 3 or 4 times a year. A 10% correction, that happens about once a year, on average. Even a big, scary 20% bear market tends to show up every 3 years or so. The takeaway is crystal clear. Market drops aren't some rare catastrophe. They're a regular, recurring part of the journey.
And this is where we find the ultimate tool for managing that risk: time. If you invested in Swiss stocks for just 1 year, you had about a 28% chance of losing money over the last half century.
But watch what happens when you just extend your timeline. At 5 years, that chance drops to 16%. And at 10 years, it drops to 0. That's right. In the last 50 years, there has not been a single 10-year period where investors lost money in the Swiss stock market.
So we know we need to be in the market and we need to be in it for the long term. But what exactly should we be buying? This isn't about gambling or throwing darts at a board. It's about having a disciplined method for picking the right kind of investments.
The focus should always be on quality companies. These aren't the flashy, speculative bets. We're talking about businesses with proven, solid track records. Think of companies that grow their sales and profits consistently, have strong brands that let them set prices, aren't drowning in debt, and are so stable they can often keep paying out dividends even during a recession.
Let's make this concrete. A company like Givaudan, a world leader in flavors and fragrances, is a perfect example of quality. Their business is incredibly stable and highly profitable. On the other hand, you want to stay away from companies with unpredictable revenue, crazy high costs, a mountain of debt, and a history of cutting their dividend when things get tough. The difference is night and day.
Now, finding these great companies isn't guesswork. It's a structured 3-step process. First, you do the fundamental homework to find the best businesses out there. Second, you build a focused portfolio of those top companies, maybe 20 or 30 of them. And third, you actively manage your risk. This whole system is designed to take emotion out of the driver's seat and replace it with rational, repeatable steps. Okay, we have covered a lot of ground, so let's boil it all down to the key rules you need to remember to actually succeed as a long-term investor. Here they are. Number 1, stop waiting for the perfect moment to invest. It's a myth. It doesn't exist, and trying to time the market is a game for fools. Number 2, accept that the ups and downs are normal. Your emotions will lie to you, but the data won't. And number 3, your greatest advantage is time. A long-term perspective is the only reliable way to ride out the bumps and capture that incredible growth. And we'll end with this powerful idea from the legendary investor Peter Lynch. He's saying that the biggest risk isn't the market correction itself, it's the mistakes you make trying to avoid it. So the takeaway here is clear. Stay disciplined, focus on quality, think long-term, and let the engine of the market work for you. Thanks for watching.